How you doing, friends? Ernie here, and it is... what do I have here? How you doing, friends? Ernie here, and it is... I have... There we go. That's a fail. How you doing, friends? Ernie here, and that was just another window open. How you doing? It is Tuesday, August 16th, quarter past the hour. We have 45 minutes left in this session. And it's a crazy session. This session has been really wild. Huge move up, followed by a huge move down. For us in our service, it meant another excellent trade 2 days in a row. Actually, 3 days in a row, because Friday wasn't and Thursday was a great trade too. Jeez, that's 4 days in a row. Fantastic trades. Yeah, that'll help the P&L, especially considering that our risk is like this tiny and the potential profits are like this. And that was the case today. It was certainly the case yesterday. I think yesterday, anywhere from a 400 to 500% return on your risk capital. Today was about 400% return. And similar marks on Friday and Thursday. Thursday maybe a little bit less, but who's counting? So that's all good. Yeah, let's see here. I'm all switched up here. I've got, let's see. I've got everything in a tizzy. I'm sitting
Returning visitor.
I'm sitting down at my desk as opposed to standing. And so I'm using this camera as opposed to that camera. All right, let's see here. Who do we have? Let's do a roll call. It's a little early, but that's okay. We have Dan. How you doing, Dan? Nice to see you. And we have Will Do. There. I'm going to click on him here, there. And Taylor, nice to see you there. Donald. Kevin. Adam. Alan, all the usual suspects. We're taking your names, writing them down. So let me, oh, wow, everyone's now showing up. Everyone wants their names said. There's Jim, how you doing? And One Worm Army. I guess that works in Dune, nowhere else. And Jeffrey Davis, how you doing? And Jeffrey Randolph. And Robert Weitzer from Austria. Tim Dodds and Kevin Rutledge, how you doing? Jim wants money. All right. We all want money. And Mohammed. Yes, it's a feel-good day when making great profit. That's very true. And it really was a great day. We have Greg Rubin. How you, man? Excellent. We have a great crowd today. So, yeah, today was a very interesting day. Here, it's back here. Let me get rid of this little message here. Hold on. Just need to move this way over here. There we go. All right. So it's a little blurry, right? And this is in the way here. So you can see it. It goes way up, and you know, it's kind of like the escalator up, but this is a very fast escalator, and not the elevator down. It looks like somebody jumped out of the window, and then splatted right there. That is a crazy day. That, my friends, looks like to me, when, you know, if you were to take a look at the daily candle, that looks like a potential reversal candle. I think we would have to go down, if we were to get down below the open. Where is the open? Looks like the open is right about there. If we can finish the day below this open, then I would say that is a prototypical reversal candle. And what does that mean? Well, this It's total speculation. I have no idea. I'm just throwing it out there. And, what is this candle stuff anyways? But reversal candles have a fair level of statistical probability. And I don't know, could this be the end of the bear market rally? One thing that let me bring the chart online here so we can take a better look at this. All right. So let's go to the daily chart. And, when I look at this daily chart, and you just look at each of the impulsive moves up and then the consolidations, impulsive move up, consolidation. So we started here off the bottom back in mid-June, and we had a rally. We kind of consolidated, then another rally, consolidated, a rally, consolidated, a rally, small consolidation, followed by a rally and another smaller consolidation, and then another rally today, and then that reversed. If you look at each one of these impulsive moves up, these rallies, they're getting smaller and smaller. So this is a big one. That's a less than big one, a little less, little less, little less, little less, really less. And then to cap it off at the very top with a huge reversal. So I don't know. That to me looks like something's weakening or something's going to happen here. What I had expected to happen after we got through these two LVNs and see we have this volume node T0 and T1. Now you're saying, where's the volume node, Ernie? I don't see any stinking T0 volume node. Well, it's there. It's just that we have to bring on more information to see it. Let's see here. There it is. So T0 and T1 are kind of like the same node, but we broke them up into two. And then there is this huge LVN here, and there were two low points in that LVN. This one that we blasted through yesterday, and then this one today we blasted through. And typically when you blast through them, you go up to the next volume node, which would be T2 here. That would be the next step up. But it never made it, at least today. There's always tomorrow. It could very well be that this is just a temporary resting point or something, and the market could, in fact, get up there tomorrow. But to me, that looks like a withering or weakening rally. Some people might look at this and say, oh, it looks like a wedge of some sort, I guess. But it has that very prototypical swoop up, right? It's swooped up and then extended. And then right at the peak of its extension, it seems to have lost some gas. And this could be the top of this bear market rally. I don't know. Now, let's consider a few things. I just saw an article from, I think it was Fox News, and they were talking to and I didn't read the article, I just saw the headline, and the headline said it all. It was the former director of the CBO, the Congressional Budget Office, I think that is, and they're the ones that score all of the bills and whether or not they actually do what they say they're going to do. And in particular, this one, he was scoring. Well, he wasn't scoring, but I guess because he was the former director of the CBO. I don't know if that's how people do. I don't know if that's the current vernacular or the lingo, but that sounds good. The CBO. He probably, knows the formula and looked at that and said, looking at the Democrat, what is it called? The Inflation Reduction Act. Let me tell you a little secret about acts or any kind of bill. Anytime, whatever they're named, right, you can be damn well sure that what they are named will be exactly what they accomplish, exactly the opposite. I'm sorry, the exact opposite of what they accomplish. So like the Patriot Act, for instance, that certainly didn't create any patriots. If anything, the exact opposite. And here we have the inflation reduction bill. We know for a fact that there is no way that spending $500 million will reduce inflation, when we know for sure that inflation is caused directly by government spending, right? So how do you do more government spending to reduce inflation? You cannot. It is impossible. So anyways, this former director looked at it and said, this is just crazy. There's no way that this does a thing for inflation. And that came out this afternoon. I don't know if it was timed well with this market, but all of it, you saw the reversal. The reversal was crazy. I wonder if that came out, when the former director came out. Now, I don't know if he carries any weight or not, but the market and Wall Street are extremely sensitive about this whole idea of inflation because, quite frankly, they're more interested in how the Fed will react to something like this. So if there's more inflation, that means that the Fed is going to continue raising interest rates, and that's bad for the market. So that could be why this came down. That's my speculation. I have no idea, but it could be. I know that Wall Street and institutions are extremely sensitive to that. Now we're moving up. They might be thinking, hey, this guy's just, he was with the SIBO, but he's, he's a nobody now, and he was on Fox News. I don't know what that means, but I just thought I'd throw it in there. But look, the market now is turning up again. In any event, we had a trade on today that was centered at 43.20. That's right up here. And it was a butterfly out of the money with about a 1-to-9 risk to reward ratio. So you could put down a very small amount and make a very large amount. Like I said, most people probably made about 400%. And the direction was to get out right around that area. And it was really based on, we have a rather sophisticated, not sophisticated, but a dynamic way of getting out of the trade based on the time left in that trade. As you know, with the butterfly, the profit is ever expanding. And if it's expanding while price is going up, it'll expand faster. When price goes down, you might get a kind of liquidity crunch. And so we got out before that liquidity crunch occurred with about a 400 to 500% return. There could have been more if the market just stayed there for a while, and that would have been great, but it didn't. So anyways, that was a great trade today. And yesterday, as you saw, we nearly pinned a trade, and that was, that trade was a return of about 400 or 500% as well. So those are 2 good days in a row. And, I think that we're making up for lost time because over the past 3 weeks, these types of trades have been fewer and far between. On average, we get these, what we call pinned trades, about 1 out of every 10 trades, where we make these, much larger return on our capital. And most of the time, we're making trades that return 150, 200% in that range. Sometimes, 250, sometimes 300. But when it jumps up to 500, 600, 800, 1,000%, those are the trades that happen a little less frequently. About 10% is the average. And we haven't been doing that for the past 3 weeks, and I think it has a lot to do with this bear market rally. And I guess the cognitive dissonance of or the dichotomy between a market going up yet seeing bad economic reports every day. And, so you don't want to be long because the reports are saying go short. But in fact, you have to think like a Wall Street trader or an institution. And they don't care about the report. They only care about what the data will compel the Federal Reserve to do. Will that compel them to be more accommodative or less accommodative monetary policy? That's all they care about. How expensive is the money? And so from the Fed's point of view, any kind of news comes out that would cause them to continue to raise interest rates or accelerate the rate hikes, then Wall Street's not going to like that. If it causes them to decelerate, Wall Street's going to like that. The problem really, though, is that we're stuck between a rock and a hard place. And that's because if you raise interest rates when you're already in a recession, that's going to exacerbate the recession, make it worse, make it much worse. Now, that could ultimately be a good thing from the investor's point of view, because if we make it much worse, then they have to stop raising interest rates and then maybe even flip and start doing a form of quantitative easing. The problem now, and again, this is another problem, that we have this extremely high inflation while in recession, which is commonly referred to as stagflation. If they choose to then become quantitative easing partners, and start reducing interest rates and printing funny money, then that has the effect of increasing inflation. So you see, you can't win either way. And I think that situation that we've had for the past several weeks has been why this has been a very difficult trading environment for most people. So, and it showed in our performance. Now, I mean, my performance hasn't been bad, but it hasn't been stellar either. And with this experimental trade that we're doing right now, which worked so fantastically before the bear market rally, now has kind of stagnated. And we've had 19 trades, and we're essentially flat. It's down a little bit, down, $89, like big deal. That's after 19 trades. So we're flat, and we had a lot of losers in a row. We started off well, and then it just sort of petered out. And again, I think that is because of this unusual environment that we're in. So on the other hand, that is a great testament of this strategy, that during what I consider one of the most difficult trading environments that I have ever experienced, and I've been trading for 30 plus years, these last 3 weeks have been the most difficult trading I've ever seen, the most difficult trading environment. And it's mostly because of this convoluted way that you have to kind of assess the market and figure out what the Fed's going to do, when instead of just doing what you would normally do and then assess the market based on reality, right? A equals B and B equals C. Now it's like, in that case, A doesn't necessarily equal C, even though A equals B and B equals C. A might equal C prime or D or X. and there's no linkage between A and X. So that's what we're up against. So I hope that makes sense. Let's see, we got some comments here. Oh, Mohammed says, thanks for your coaching. Oh, you're very welcome. And by the way, that's exactly what our system is all about. I am a coach to 650 people. Alan, this act or bill creates a climate bank run by the EPA. Oh, that's interesting. Haven't even thought about that. Hi, everyone. No trade today? Not yet. Mr. Happy Street, man, you are anxious, aren't you? So what did we do better this week than last week, Ernie? I'm not sure that, Thursday and Friday were good days. And if you have just in this service, in this strategy, if you just have one good day a week, you're doing fantastic. That's really all that's required. But last week was okay. I think that now things are coming to a crux. We're getting down to the end of this bear market rally, and I think things are normalizing a little bit more, and that might be the difference. I really don't know. And you don't really know these things until you look back at it, right? When you start looking at these things in hindsight, then everything starts becoming more clear. When you're in the midst of it all, it's very difficult to tell. all you can really do is keep going forward with your strategy. Excuse me. Keep going forward with your strategy. Do, play your strategy. And that's about it. You can contract a little if you're uncertain or don't take a trade, and that's fine. And I have no problem with that. I mean, if you're looking at opportunities and they just don't look right, don't force a trade. And with our strategy, it kind of does that for you. If the criteria isn't there, then we just don't take a trade. Ernie, looking at the last few weeks, ES, until today, looks like we are headed for consolidation. I would say probably, I'm going to say not consolidation, maybe a reversal. That's what I think. I think that this bear market rally is over. We're very close to over. The Rambo 911, that's an interesting name. Do hedge funds or big traders do multi-leg trades like butterflies? A lot of people say they just like doing straight calls and puts on CNBC. I hear someone buy a couple thousand calls or puts, not butterflies. You have no idea what they're doing. They're doing everything and anything. And to lump it all into one basket makes no sense. For the most part, I mean, a butterfly is a valid strategy that they may put on, but for the most part, most professional traders are doing one of two things. Either they're conducting some sort of arbitrage, or they're collecting premium. So you could put a butterfly in that camp of collecting premium. So whether they, are they doing straight calls and puts? I mean, all of these strategies have their place, but that's not the way the world works. So if you're hearing it on CNBC, oh God, why are you listening to CNBC? CNBC is the mouth of the broker. And their purpose in life is to get you to push buttons. Because if you can push buttons, that means that the broker makes commission. That's pretty much it. So take it from there. CNBC is mainstream media. They're not there to tell you the truth or to give you advice. They're there to really make you push buttons or buy stuff, right? That's it. All right. Let's see. Do we have a trade for today? I look at this chart. Let's see, where are we at? There we go. So I look at this chart, and we have three primary areas of consolidation. We have something near the open and the overnight session down here between, let's say, 42.90 and 42.95. Right down here. And then we have this other area of consolidation, and it's kind of like a forked tongue between 43.05 and 40. Let's just say if we take these guys here, about 43.05 to 43.15. I think that we're probably going to end up either on the POC between these two, maybe this right here, at about 43.10, let's call it, to 43, well, it's somewhere between 43.15 and 43.10. Let's call that 43.10. And this one down here, 43. Yeah, I'd say 43.10. That's where I would peg it. So it might make sense to put something at 43.15. And it looks like the market wants to recover some of this drop. I really don't understand what this drop was about. I looked around for some news, and as I said, I found the SIBO former director had made a comment, and I don't know if that was the reason for this. But the market got spooked by something. And the only thing that can, like I said, can really spook the market is if they think the Fed is going to be working against them. So that's why I put the two together. Now, what trade do we do? Now, let me explain a little bit about this trade here. This trade is an experimental trade. It's not part of our normal course of action in 0-DTE in our strategy or methods or anything like that. However, this time of the day, I'm going to reserve for putting on just such trades, what we call experimental trades that we're exploring. And really, the only way to explore trades or strategies in their best light is to put real money to them. Put real money and actually trade them and then look at what you learn. And I felt like, well, then that would also be a great opportunity to show everybody in the world what we're doing. Now, of course, this is not representative of, what our strategy is doing, because these aren't our strategy. However, you still get the idea. And we're still following through with the principle of asymmetric trades, where we put on very small risk with huge outside return. The thing that might differ is the time of day that we trade, the overall strategy, the setup, and that sort of thing. On this final hour trade, we're really trying to compress that premium decay. That's the purpose of this trade. And so the closer that we get to the expiration to take the trade, the better. But here we're about 15 minutes away, and I don't know if we're going to be hanging out here or if we're going to drop down to near the close. It's really unclear, especially after this big drop. So I'm going to declare today, and I know you're not going to like this, I'm going to declare today a no-trade day, because I don't see anything clear. Like, if we didn't have this here, this big drop, then I would have said, hey, we're going to probably do what I had suspected we were going to do right from the very beginning, and that was continue on right up until this T2 target node up here. That's this red area. And that was today's trade, basically. I decided to put a strategy on that was overlapping, from here down to about here. And we hit that, and that's good. And we got out, that's good. But it never continued. And so I was thinking for the final hour trade, that's what it would have been. That continuation into T2. But it didn't. So now we have this drop that kind of throws a fly in the ointment. And now it's recovered a little bit. I don't know if it's going to go down again. I just don't know. I don't see a solid trade here. I guess I could make this up and say, this little area of consolidation, this forked tongue here, is something we can shoot for. But I'd be more inclined to go with this thing down at the bottom. So we're going to rack this up to a no trade. Now, let's see, is nothing at all wrong with a no trade. Okay, thank you for that. Is Mohammed, yay, the spread looks too wide on SPX for an end-of-day trade as well. Okay, good. Kamoy Sangster, how you doing? Market hit the 200 and dropped. Yeah, that's what it did. It hit the 200 and dropped. That's funny. Let's confirm that. But first of all, that really means very little. It is true that there are some sell programs, some algo sell programs that are based on the 200-day. But yeah, I'm not convinced that that's what happened. Let's find out. That'll be an interesting thing. Yeah, your guess is as good as anybody else's, I guess. But I'm gonna check it just for the hell of it, right? Just see what happens. All right, so we'll put an indicator up here. And let's see, moving average. Should it be the exponential moving average or just the regular moving average? Nobody knows. All right, so we got a daily chart. And here we're going to make it the 200. All right. Oh, look at that. It touched the 200. Must be it. But see, you know, it touched the 200 here and here and here and here and here and here. I guess one could make the argument that it may have touched the 200 here as well. But, you know, you can go across and you can look at so many other times that it touched the 200 and it didn't do squat. And so the times that it does, to declare that that's why it happened, that doesn't hold water with me. All right, Robert has a no trade question. Do you use the option volume before the trade? Yes, we often look at the option volume, but we're more interested in the rate of change of the option volume as opposed to just whatever the volume is, because it's more important about when that volume changed and is it in the process of changing, right? So let's see here. Let's see if we can bring that online. So this is Thinkorswim. There's a trade I made today. $1.50 in, 370 out for 220. Not bad. Analyze. So we'll look at the puts and the calls. Let's move this down a little bit so we get a better look at the options chain. And it looks like the call side is definitely heavier. You know, look at this block of calls, all with 50,000 plus. There's 1, 2, 3, 4, 5 different strikes between 43.10 and 43.30 that are all 50,000 or more. And we don't have anything like that on the put side. On the other hand, yeah, nothing like that at all. And I don't see anything that is changing Let's see, are these changing rapidly? Yeah, it looks like there's more activity on the call side. You know, just watching these three right here from 43.15 to 43.25. But it's hard to tell just looking at the numbers on whether or not that is that's significant. But, you know, there's a lot of calls that are happening here. And there's really not much going on the downside. So that leads me to believe that the market is anticipating that it will go up a little bit more. All right. The Rambo 911 asks, if I put on, say, 10 contracts of Butterfly on SPX and then start peeling contracts off once in profit, will that trigger day trading pattern? Yes, it will. Because every single time that you make a transaction, that will be another day trade rule, another day trade. And you'll only be able to do 3 of those. And once you get on the 4th one, they're going to restrict you. You don't want that. Now, you could do what we call the day trading hack, the defeat hack, the pattern day trade or defeat hack, but that would be pretty complex. It's not terribly complex, but it is not easy. And so let's say that they were all puts that you put on, and then you wanted to take them off, what you would do is you would take the exact same call, same strikes. Now you couldn't do it with individual contracts. You could do it with a butterfly though. So for instance, let's say you put on a butterfly with 10 positions. You could then take it off with a butterfly, a call butterfly with the exact same strikes at the position that you want to take it off, and then let both ride into expiration, and you will get no pattern day trader strikes. Now, that every transaction that you do there that is taking it off, once you put one on and take it off, and then take it off, that's a transaction, and that would count towards your pattern day trader strikes, and you only get 3 of them. The trick is to put on trades that cancel the other trades without closing any trades. That's the key. And it can get pretty complex, so you have to be careful. I see since we've been talking, the calls at these strikes have gone up about 600, 700 contracts. And really virtually no change on the put side. It is 7 minutes left in the market. I mean, we have been going up, but not really breaking out. Let's see. Yeah, not much. Luke asks, how do butterflies make money? I have only really ever traded short verticals, but I guess he says I can't seem to understand. I don't know if you can seem to understand them or you can't seem to understand them. So it's just like any debit trade. You know, you get in at a small debit and you hopefully get out of them on a large debit. So, or a credit. You put on, you remove it at a higher price. Get in at a low price, get out at a higher price. And the way they make money is through the premium decay, in that time period. And the nice thing about butterflies is that you don't have to be inside the butterfly to actually make money. A lot of our trades, we make money just being on the outside of the butterfly. But that's very difficult if you don't get the kind of risk to reward that we get. So in other words, if you put on a butterfly at the money, if you put the short strikes at the money, you're not going to get a very good risk to reward, maybe 1-to-1 at best. Very rarely will you get a good risk to reward. And what will happen is price will move, and it will move outside of the butterfly, and it'll be very difficult. You won't make any money outside the butterfly, that's for sure. However, if you put on a butterfly that is way outside the money, then you can get a risk to reward equation that is very favorable to making money in a wider range of prices. Let's see. Michael says, yep, made the error today and the opposite side order and gave back my profits. Rambo. Out of all the different variations of butterfly. The regular one's still your favorite. It's the only one we do. Not when we say regular, what we do is symmetrical butterflies. Symmetrical butterflies, slightly out of the money. That's what we do. So to give you an idea, let's see. So this was today's trade. We put it on at $1.50. All right. When we got into the trade, price was out here somewhere, right about here. The profit curve, this purple line, would extend way beyond left and right. And so your profitable area was very, very, very wide, much wider than the actual expiration or break-even points at expiration. They were way out here, probably 2.5 times wider than the butterfly itself. So we put it on out here with the anticipation that we're going to move towards it. And then as soon as we start moving towards it, we start making profit. If we just hang out right out here for a good portion of the day, that profit curve continues to rise, and we are inside of that rise, and so we're benefiting from it. So we could for instance, you could be outside of here and actually get multiples of the risk that you're taking. Like, see here, the risk is $150. You could be sitting right here, and then as that day pursues, that profit curve comes way up here. You could have as much as 200, 300% profit while outside. And then if you get inside, of course, you're going to benefit from profit. Now, for us, for the majority of the day, we had profits anywhere from $500 to $700. And then it finally moved out and then out again, then back through. It was crazy, that move. But we got out even before it started to move. I don't know. Isn't the Christmas tree one the same risk graph, just 1 by 3 by 2? That's an unbalanced butterfly. So we don't do anything that has a skewed risk to reward. If you have too much risk on one side compared to the other, chances are that eventually you're going to hit that other side, that deep risk on the other side. So we don't do that. We take only the symmetrical butterflies so that we always know exactly what our risk is. And we never get caught in days like today where if you had put on, say, an unbalanced or a broken wing fly that had a lot of risk on one side, you could have potentially been caught and had a huge loss. We don't want that to happen. So we have well-defined small risk, and that way we only concentrate on managing our profits. We don't concentrate at all, hardly, at managing our risks, because our risks are small and well-known. In fact, most of our trades, the risk, we're more than willing to just let that risk go if the trade doesn't work out. So, big difference. Robert Weiser says, the tasty trade prefer broken wing butterfly. What's the edge for your symmetrical butterflies? It's not what's the edge. It's what's the lack of risk, right? Yeah, sure. They prefer broken wing butterflies, just like some people like to dance on the edge of the cliff because, they can make more money that way. What they don't tell you is the problem with that. What happens when price moves very quickly against, what you're expecting, and you fall into a huge drawdown, or you get on that risk side. Sure, on the short side, when you first enter the trade, it looks like the risk is only, say, $50, and then on the other side of the trade, the risk is $500. But you look at it, you say, "Oh, that risk that's $500, that's 2 standard deviations away. You know, that's an 80. There's only a 15% chance that I'm going to hit that." Well, how often do you think that you're going to hit that 15% chance? It's going to happen. Trust me, it's going to happen. Not only is it going to happen once, but there are going to be times when it happens twice in a row. And then you're going to be very sad. With a symmetrical butterfly, that never happens, ever. That's the edge. Yeah, I agree 100%. JP Swede, tasty trade, fantastic education, but don't trade like them. The reason why they want you to trade that way, think about this. Why does Tasty Trade want you to trade their way? Do they want you to trade their way so that you'll make gobs of money? Is that really what they want? Is that really what they want? And so how do they make money? You mean they're going to give away all this free education and show you how to trade in such a way where you're putting on all kinds of transactions and strategies and, just follow your pop and rock, right? What do they get out of it? Oh, wait a minute. They opened up a brokerage and now they want you to trade in their brokerage with their way. Oh, isn't that interesting? Yeah, trade the Tasty Trade way in our special brokerage. And we're going to give you this really, really cool trading platform. It's all graphical and shit. Oh, you're going to love it. Just pop and rock it. Do 100 transactions a day. You're going to love it. Trade the Tasty Trade way. Want some more free education? It's so blatantly obvious. You know that that's what they were leaning towards all along. All right, Luke wants to know, is being assigned not a concern for butterflies? It's not a concern whether it's a butterfly or not. There's zero concern for us. Because first of all, we're trading the SPX, and there is no chance of assignment. There is no, all SPX trades are settled in cash. There is no assignment. There's actually an assignment flag that goes up with the SPX, but that's because, it depends on the broker. They just brought up the flag because you're maybe in the money with a short strike, but it doesn't matter because you're going to settle that with cash. They're not, with the SPX, there is no contract to put into your account that you're going to be liable for. There is none. So how do you get assigned? You can't get assigned. Now, you could get assigned if you're trading the E-mini S&P futures. You could get assigned a futures contract. And there's a really simple answer to this. You just simply close the trade before you go to expiration. Or you wait for it to go to expiration, and then you prepare yourself for when that contract shows up into your account, which will be about 5 minutes after the market closes, and then you just close it. Done. So now you brought it all the way to expiration, and then you closed it. And if you're quick enough, you should get away with slippage, which might be one tick, right? And that tick might be in your favor or against you. Now, if the market's really moving afterwards, then that's a bad strategy. If you're going into a volatile market and you let it go into expiration with the E-mini futures, that's just dumb. Just get out before the market closes. But with the SPX, there is no assignment. None. Zero assignment. Learn how to make most trades before bleeding out your account. Well, see, that's the problem with a lot of people, that they just want to jump into trading, give them the alerts, and then they think they're going to make money. When what they don't realize is that putting on the trade is only part of making money. Then you have to take it off. And also, you have to execute flawlessly. You also have to know what to do in the event of a disaster when something happens that may be out of your control. So anybody that thinks that they can just get into trading and just feed them alerts, I guarantee they're going to be a loser. As a matter of fact, 98% of people that do it are losers. Let's see. AJ says they are also funded by market makers, dealers, to pull more folks to trade. Is that right? No, market makers are actually employees of the brokerage. All right. So, and the reason for that is that that's one of the income sources that the brokerage has. The market maker has the perfect trade. They cannot lose. A market maker, when they make a trade, by definition cannot lose because they have an arbitrage. They make money based on the spread. So they make the difference of the spread. There's always a spread. So therefore they always make money. Period. End of story. Robert says that he's a psychotherapist. Uh-oh. Tasty want to earn money. That's okay. But for the European market, it's one of the serious advisor. I'm not sure exactly what you're saying, that for the European market, it's one of the... You don't agree with trade small, trade often? No. I don't. I don't agree in the law of large numbers, and I don't agree with high probability trades. Right? You might agree with it. Good for you. Go forth, young man. Make money. Yeah, I'm trying to work out this this wording here. Tasty. Okay. But for the European market, it's one of the serious advisors. So are you saying that Tasty Trade is a trusted advisor of Europeans? Is that what you're trying to say? I'm not sure exactly what you're trying to say there. So, yeah, so no, I don't agree with the high probability trade. You know, get your... Yeah, I'm sure that a lot of Europeans, just like Americans, are very trusting of Tasty Trade, and the education they put out is fantastic. But don't trade their methodology. Just don't. It's a losing methodology, a losing strategy. You know, they employ basically the same tactic that every sell-side analyst and every broker does. They hire bright young kids to be the face of their organization. They provide all kinds of analysis for you for free, and you never question why it's all for free. All right, Ernie, under what conditions should we be doing a hang trade? So what you're really saying is under what conditions should we place a trade way out of the money and give it a price that, you know, it seems unreasonable. I mean, I'm answering the question here. You know, if you see some opportunity and you think that price overnight is going to really spike or really, you know, drop or whatever the case may be, and you want to get in on that, then put on a trade that just seems totally unreasonable. That's what I would call a hanging trade. Some of my best trades ever have been hanging trades where I put them way out of the money. There's a little story about a guy who became the #1 S&P trader in the world when they still had the open cry at the Chicago Board of Exchange, or the CME, the Chicago Mercantile Exchange, when they had the pits, the trading pits. They used to call him number one. Anyways, the way he got started in the beginning, or the way he first got funded, he had his own money. He had about $50,000, and he wanted to try his luck at trading gold, I believe it was. And so he bought himself a seat on the exchange and went back and forth and made a little bit of money, then lost a little bit of money, then lost a lot of money. And he was just about to give it all up, and he did give it all up. And he left for that night, and he forgot to take a trade off. He thought it was a total loser. He came back the next day, and there was like $50,000 in his account. Something crazy happened overnight. Since then, it gave him newfound hope that he could be a great trader. And he went on to parlay that $50,000 and then raise more money, and eventually became the number one volume trader on the S&P. So that would be an example of a hanging trade. You never know. All right. My opinion is that there is a chance of the move happening, and you can get it really cheap and then hang that trade. Yeah, that's essentially what it is. Now, number one did it by accident, but you can do it purposefully. He has a name, and you can find it out. I'm not going to out him, but they used to refer to him as number one. Like on Star Trek, the Captain Picard refers to Riker as number one. But everybody, the pit crew and the open cry specialist, the guy who actually called the markets, they all referred to him as number one. Yeah, that was the futures. Do you think that Tom Sosnoff is a profitable trader or just made a bunch of money selling to TradeStation? Well, he made $400 million selling TradeStation. Now he has the Tastyworks brokerage, where he has hundreds of thousands of people joining his brokerage. Do you think he cares about making money off of one or two trades a day or a few trades a day? What he cares about is getting you to trade like him and convincing you that pop and rock is the way to trade, and putting on lots of small trades will make you a winner, on his brokerage. Nothing's for free. Nothing. So the market closed a while ago while we were sitting here talking. No, but Tom Sosnoff, if you follow his trades, he's not making money. He's just putting on as many trades as he can, and all the different variations. They talk about all the different trades that you can put on. Yeah, the Karen super trader story drama. There's always a Karen super trader, or there's always some super trader around the corner. There is always somebody who got super lucky, and then they'll want to, highlight that person. Most of these people, they get super lucky, just like people get super lucky winning the lottery, and then the next year or two, they're dead, or they're poor. Selling Thinkorswim and Tastyworks, he is always rolling trades. Well, that's just a singular strategy in some strategies, right? You roll trades on certain types of premium collection trades, or things like covered calls and some iron butterflies. You can roll trades, or selling puts. You can roll a trade. And basically that's resetting the clock and collecting a little bit more premium to try to give you more time to be a winner. That's all that is. Doesn't mean you're a winner. Just when you have to roll a trade, that means that you lost, and you're going to stay in the game and give yourself more room to hopefully win. Yeah, I know. Karen blew up her account. I knew that. That was the easiest prediction to ever make. Sosnoff has admitted the difficulty in transitioning to the screen. He never transitioned to the screen. Yes, he was a market maker. Of course it's difficult. When you're a market maker, like I said, you make money, period. End of story. You do not lose money as a market maker. You can't lose money unless you're an idiot. So you make money. You have this wonderful job. And if the more volume that you can create, the more money you make. It has nothing to do with your smarts. You make money on the spread. And sure, yeah, then transitioning to the quote screen means that now he's going to try to trade on his own. He's in now a position where he does not have a perfect arbitrage. He has no arbitrage at all. So now he has to figure out how to make money. So he creates something that is akin to what he'll call a statistical arbitrage. He thinks that by working the statistics with his magic, that he can magically form a trade strategy that all you have to do is dial in your pop and rock, dial in the probability of profit that you want to put on and the return on capital you want to put on, and you put enough trades on that match those two things, and you will, with the law of large numbers, eventually you will converge to that little nirvana. It's total bullshit. Well, anyways, that's the strategy that they sell you on. Muhammad says, yes, all false hope on Tasty. All false hope on Tasty. They make the money. Ernie is much better. Zero DTE. Just give some time. Well, see, zero DTE works over time. It's a low probability strategy. The cool part about it is that the risk is so small that you never have a big drawdown. It's always a small, and then the wins that you get periodically, and they're not just periodic. You get a wide range of wins. When you trade high probability, you have a very small range of winning trades that you can make compared to the risk. The risk is huge, and then the amount that you can make is very small. So you have a very wide range of, put it another way, you have a very wide range of losers that you can make and a very small range of winners. With the way we trade, it's a very small range of losers and a very wide range of winners. The difference is that the high probability way can never make the big win, ever. It just does not happen because you can't do it. It's physically impossible. The trades aren't structured that way. With our way, we have a very good chance of making the big winner on a regular basis. Like I said earlier, about 10 or 15% of the time. The rest of the time, we make a spectrum of winners that are all larger than the biggest winner that they have on their high probability trades. Now, they'll tell you that, well, what you do is you manage your risk. Well, what they're really saying is that you're managing your losers. It's all the same thing. It's very easy to convince people to come into a high probability strategy because there's an allure to it of winning a lot constantly. Tiny little wins. They'll call it income trading or whatever they want to call it. They never really tell you, though, what the risk is. You have to manage that risk. You have to be in the right mindset. You need to work on your psychology. You need, better risk management. You got to learn all these techniques for managing your risk. And with all of that, still 98% of all day traders lose money. So, anyways, there's my argument for or against high probability trading. It is really a ruse. It is. Let me just say this, and I've said this many times, and you don't know. A lot of you don't know who I am or what I've done or where I've been. I've got 40 years in this industry. And I've helped the brokers. When the internet came online, I helped the biggest brokers in the world put their brokerage online. That's what I did for a living. with Fidelity, Credit Suisse, and many, many others. Those were the first ones that I did. But then when I joined Sun Microsystems as chief architect, we essentially built out all the systems on Wall Street, Sun Microsystems. All the hardware and all of the software systems were all based on Sun technology. And all of that was essentially under my purview. My teams literally went out and worked with all of the investment banks, the exchanges, and everybody else and built them. So I've been around this business for a long time. All of the major institutions, financial houses, sell-side analysts, and others. And, you know, I was there from the beginning. I'm telling you from not secondhand information, but firsthand information from the person who helped them implement their systems, what they are all about. And what I said before is what they are all about. It's called the broker narrative. They want you to trade lots and lots and lots. High probability trades. That's what they want, because that's what makes them the most money. What's a crazy example of what a hanging trade could look like? Oh, I don't know. You could put on like a put 100 points up, I guess, and hope that we're going to get some sort of unusual spike overnight, and it hits it and then comes back down, and makes you 100 ES points. You know, that might be something. Did you watch the Big Short? The whole Big Short movie was all about taking asymmetric trades, small risk for huge potential wins. They found this opportunity, and then they just put on as many of these small trades as they possibly could because the return was crazy. Sun Microsystems, haven't heard of them mentioned in 30 years. Well, it's been a little less than that, but they were bought by Oracle back in 2006, I believe. 2004, 2006. No, I was chief architect for professional services back in 98 to 2001, right when all these new brokerages were coming online. Are you a fan of adjusting trades or just put on and take off? Yeah, put on and take off. There are some strategies that you can use that are designed for adjustment, like selling puts. You know, that's designed. You know, you keep on rolling until you're right. And if you have deep enough pockets, you can always be right. The problem is that you'll tie up a lot of margin in the meantime, and you might have a little bit of a drawdown. You can do the same thing with covered calls. I mean, that's essentially, or the wheel strategy. These are adjustments. We're going to experiment, just like what we do here with the final hour trade, with an adjustment trade where we put out of the money iron condors and then roll the weak side towards price until we win, right? So the idea here is that as long as we keep on rolling the weak side, we always maintain our maximum loss, but keep on building the potential profit. So that's an idea that I want to try, and we will try it here in the final hour. So we'll try that. But generally, adjustments are not worth it. Hans, Die, Sun Microsystems, Inc., War, Von Computer. I do not speak German. I think that's German. I have no idea what that says. Rambo 911. I see your argument with these out-of-the-money credit spreads. What about insurance companies? What do? They basically sell puts. That's what insurance That's what an insurance company is. They're a big put seller. Yeah. So what did Hans say? I've only been trading for about a year. What are your thoughts on David Jaffe's trading method? His method essentially is selling puts. And David is a very experienced trader. He knows what he's doing. He's a good guy. He knows me too, and I'm sure that he'll tell you too that I'm a good guy. All right. So that's all I'm going to say. If you have the money, his service is definitely worth it, but you're going to use a lot of margin. You need a lot of money to trade his way. Well, that's not necessarily true. You can trade in a smaller way, but if you trade what he's trading, you're going to need a lot of money. But the concept works for lower price stocks as well, just not as well. Iz says, I was an early adopter and developed commercial apps in Java when Sun first released it a while ago. Yeah, I remember. Did you know that Java, while I was there, I worked with guys like James Gosling and others that they developed Java on Mac laptops when they first came out. A lot of people don't know that. They didn't even use the Sun hardware. Oh, Hans says, Sun was a computer and software manufacturer that was incorporated into it was in 2010. I thought it was a little earlier. I think they started the process in 2006. I was gone by then. Yeah, I don't know who Victor Niederhofer is. But David is a very smart guy, and he's a good teacher. So, Today, a lot of information. It takes me a few days to understand what you say. Yeah, when you have this much useless information in your head after 40-something years, it's tough to weed through it all and then deliver the halfway useful information. All right. I think we're done here. I want to thank everybody very much for showing up and asking all these wonderful questions. If you're not a subscriber of the YouTube channel, just go down there, hit subscribe, and smash the like button for me. I'd really appreciate it. Victor was a former Soros wunderkind who blew up twice selling naked. I don't know that you would associate David with anybody that Soros is doing, or anything like a Soros. All right. Okay. Thank you all very much. Got to go now. Hope you all have a great night. All right. Got to get the big head on here. How's it going? I was getting relaxed there. See, I'm going to be on the island that is represented by this dog here in about a week. And then we'll be doing all our shows from there. Thank you very much. Peace to you all. And we'll see you tomorrow.